Hi everybody, this is the Wayrider Chronicles number 6, and I would like to put out this short video which is sort of an addendum to the video I put out recently called Let's Talk About Crypto. So once again we're talking about cryptocurrencies, and specifically we're going to talk about something called volatility, and this is a follow-on. Volatility in financial market terms simply means the amount of movement that happens or takes place in a stock, for example, a share like Apple or Microsoft. How much does it go up and down? Or same thing to do with foreign exchange. Or in this case, we're talking about a cryptocurrency, the main cryptocurrency, which is BTC, the symbol for Bitcoin. The illustration I would like to put forward, or the let's call it an illustration of what, because one of the premises, as I said in the Let's Talk About Crypto video, was that one of the premises right back in the beginning is that cryptocurrencies, and especially Bitcoin, should be used as a medium of exchange. And we went into that, I went into that in the previous video. We're talking about moving money from one part of the world to another. However, we have this problem of volatility. In the previous video, a young man from running air wallets in Melbourne was talking about liquidity, which is the ability to buy and sell something without affecting the price. In this case, we're talking about the ability to, when you buy and sell currencies, or when you transfer currency, your money from one country to another country, that there's not going to be a big difference in price. Just over the last 24 hours, there have been two major events that took place in both these, what we call in financial markets, assets. Bitcoin moved very dramatically upwards. It rallied, as we call it in the financial markets, from about 48,000 to just over 50,000, let's say 50,200, which is great. If you happen to buy at 48 and sell it over 50, you made money. You've made over 4% in a day. Fantastic. The same movement, not the same, but a similar dramatic movement of some sort. I wouldn't call it that dramatic because it wasn't such a huge move, but in foreign market terms, was publication of inflation figures this afternoon in New York, which caused a movement in the euro dollar. So we're talking about the euro as a currency and the dollar as a currency. There's an exchange rate between them. This move was about, without looking at it too closely to get to the numbers, from about 1.084 euro against dollar to 1.075. So that's a 0.5% move. What does this all mean, all these numbers? It means that if you're an exporter and you happen to be on the wrong side of one of those moves, if you were using Bitcoin to transfer your $1 million from, because you had to pay somebody, you bought something from Brazil which you needed to pay for, and you sent the Brazilian supplier of your whatever you bought from them $1 million. With that type of movement, you risk to lose $45,000. It's a lot of money. In certain cases, if you're buying and selling little widgets from China, for example, that might be your profit margin on a transaction of that size. If you used the traditional liquid, again, talking about liquidity, we can buy and sell without too much difference between the price. If you use the traditional foreign exchange market and happen to get on the wrong side of this particular move in the euro and the dollar, there's only a 0.5% difference. You lost $500, which is most businesses say, okay, fine, I lost $500, big deal. Another illustration why I sincerely believe that let's talk about using a cryptocurrency as a medium of exchange between different countries or different areas of the world. You don't really want to use it. As a business, it's not something you want to go anywhere near because of that important aspect that from one moment to the next you could be losing or gaining. Okay, if you gain, but we all know that in 9 times out of 10 when these things happen, you lose, you don't gain. That's all for now. Thanks for listening. See you guys.